Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, guys, without further ado, so I'll get started with today's topic. So today, we're going to focus on how to price for the futures or forward contract, so the capital F. All right? So the way we usually price the derivatives contract is somewhat different from the regular financial securities, such as stocks or bonds, right? Remember, what you learned to price the stocks or bonds is kind of using the cash flow discounting technique of discounting all the future cash flow back to the present. Somehow you derive a intrinsic value. But the way we price the futures or forward contract is different. This is because they are derivative contracts, so they are derived from some sort of underlying securities. So for instance, the example we did last week, the Finm futures contract is a futures contract that based on the underlying asset, which is Finm, right? So then we have futures on gold, on interest rates, even stock market index. So in other words, it is possible for us to replicate this derivative contract by using clever portfolio constructions, by using more basic securities, right? And the ability for us to correctly price this forward contract is going to be the central recipe for us to calculate the correct capital F, the forward or future price, right? So if we ever see this capital F is incorrectly priced, then there will be arbitrage opportunities. So before I begin today's example, just a couple of things aside. In today's lecture, we're just going to trade, we're just going to value the future as if they are forward, all right? Really, the minor difference between them is the daily settlement scheme for futures contract, right, market to market. But in today's lecture, we're just going to trade the valuation of futures as if they are forward. I think we're fine with that. So before I start today's example, I want to sink this idea into your mind. What is arbitrage? I think you've heard arbitrage a million times. But there are three ways that to define this arbitrage, three definitions. The first definition is that if two trading strategies always result in identical payoff in the future, then they must have same cost today, right? Otherwise, there will be arbitrage opportunities. I think this is quite intuitive. For instance, if we have two stocks, stock A and stock B, if stock A and B always have the same payoff in the future, the same outcome in the future, then they must have the same upfront cost today. Otherwise, there will be arbitrage opportunities. I think that's quite intuitive. Now, the second point, if a trading strategy which produces a fixed or known outcome essentially is riskless, therefore must earn riskless rate of return. So we're going to come back to the second point when it comes to pricing for the option products. So the second point is more relevant in later week's lecture. Now the third point is very important for today's workshop. If a trading strategy costs nothing to set up today and it's riskless, and the payoff in the future must be zero, right? Otherwise there will be arbitrage opportunity. I think this is also quite intuitive. It costs us nothing to set up today, then its payoff must be zero, right? So I will come back to this third point again and again during today's workshop. So we're going to start with something that is really, really simple, some really basic example I can think of. All right, so this example says, Westpac shares are currently trading at $22. We were told riskless rate of interest is 5% per annum, continuously compounded. Now, two people get together, so one person wants to go long, the other person wants to go short. The question they're facing is, what is the capital F? What is the correct, forward price for this agreement? You might think that this capital F has something to do with the Westpac share price. You might be telling me that, Mars, we better value this capital F by, discounting all the future cash flows Westpac Bank to that point in time, then that's your forward price. I would say you are very wrong, because this capital F has nothing to do with this, the share price of Westpac. It has nothing to do with that. So I will give you two examples to see how do we get the correct capital F for Westpac share. But for now, I will just tell you up front, the correct capital F, the forward price, should be $23.13. You might be thinking, how do I know this, right? Just trust me, that's the correct capital F. Then we're going to, I'll go through the step, and you will see why that should be the correct capital F. And we'll go through two examples. In the first example, we're going to say a forward contract with delivery in 1 year time is arranged with a forward price of $28. I will tell you up front that's way overpriced. And the second case, a forward contract with delivery in 1 year time is arranged with capital F, $21. And I'll tell you that's way underpriced. Okay, so let's say this $28 is two people willing to trade a forward contract for delivery of one Westpac share 1 year from today for $28. Okay, let's just say we're the smart people here, and we know this $28 is way overpriced. All right, so someone would like to enter into a forward contract for one Westpac share, and they're prepared to do so for $28. All right, and we are way smarter than they are, so we're going to make some arbitrage profit here. So although we know this $28 price is too high, we're not going to tell the other party. So what we would say, okay, I'm very happy to enter into this forward contract with you, and I want to go short, and I'm happy to sell you one Westpac share in 1 year from today at this beautiful price of $28. Okay, so we enter into the forward contract. Just let me try to so I try to remove this box here, but it seems like something's going on. So we might start again. Right, we know this is way overpriced. We say we're very happy to enter this short forward. I'm very happy to sell you this one Westpac share 1 year from today at this price, $28. So what is the implication today if we enter into a short forward? The implication today is nothing. We're basically just signing a piece of paper. And we just committed ourselves to sell one Westpac share 1 year from today at this price, $28. So I guess the implication today is nil, nothing. Right? We can agree on that. Now, what else can we do? So we have to think this through, what we have got ourselves into. We're entering into a short forward. The obligation is us selling one Westpac share 1 year from today for this price, $28. I think I have two choices here. Sitting at time equals 0, I have two choices here. I guess I can just do nothing and sit back for a year. A year later, I just buy one Westpac share in the market, then I sell to the other party at the price of 28. Right? So that's the naive option, naive choice. What's the problem with this naive choice? If I just do nothing today, if I just wait for a year, then I go to the market a year later, buy one Westpac share, I honor my commitment under the short forward, which I sell that Westpac share to the other party for $28. I guess the risk is we don't know what the Westpac share will be in 1 year's time, right? What if Westpac share price increased to $30 or $35? I would hate the fact that I need to buy the Westpac share at $35 a year from today, then sell to the other party for $28. Right? So I don't want to leave things to chance. I want to lock in things today. So I think we better get ourselves prepared for this short forward contract. So I guess the second option, the smarter option here, is just to buy the Westpac share today, and we keep it for a year, right? A year later, we can just sell to the other party under our short forward commitment. So remember, we're the arbitrager here, so we're going to make money for nothing. So what I'm going to do is I will just borrow some money from the bank. Let's say we borrow $22. I'll just get rid of this. It's really annoying. So we're just going to borrow $22 from a bank. Then we're just going to buy the Westpac share today, and we're going to sit on it for a year. And we, in that sense, we'll kind of get ourselves prepared for the delivery, right? So the plus sign means that we are getting the money in from the bank, and the minus $22 means that we are spending that $22 on this one Westpac share. So the net outcome today is 0. So if we add on the column, is 0. Remember, if something costs us nothing to set up today, the payoff in the future must be nothing as well. Otherwise, there will be arbitrage opportunity. All right. So let's fast forward a year, okay? Because we enter into a short forward, we're under the obligation to deliver the Westpac share. No drama with that. Why? Because I bought the Westpac share a year ago. We've been sitting on it for a year, and we're looking forward to deliver this share to the other party, right? So no drama. So we delivered Westpac share, and we sold for $28, as in this forward agreement. So the other party pay us $28. So that's the plus sign there. Why this cell is empty here? The share we bought a year ago, we delivered to the other party, so it's gone, right? So that cell there is empty. Remember, we borrowed some money a year ago. Now is the time we need to repay that money. But we need to repay that money with a bit of interest. So we were told the riskless rate of interest is 5%, right? Continuously compounded. So $22 multiplied by exponential 0.05 multiplied by 1 year horizon, that give rise to this $23.13. But we notice something here. Remember the share we sold under the short forward agreements for $28. That cash is more than enough to repay the loan we took a year ago. And that produced an arbitrage profit of $4.87. So we come to the conclusion that this correct capital F cannot be $28. It's too high. It allows smart people like us to make arbitrage profits, right? Okay, let's go to the second scenario. What if the capital F is $21? I will just tell you guys right now, it's way underpriced. So if people are willing to trade for a contract for Westpac share with delivery of 1 year time with a delivery price of $21, we immediately know this price is underpriced. There's arbitrage opportunity here. So for $21, we'll be very happy to buy at the price. So I will tell the other party, say, I'm very happy to transact with you. We're going to go long, and you go short. All right? So we're entering into this long forward contract. What is the implication if I enter into long forward? I committed myself to buy one Westpac share a year from today for the price of $21, right? But the implication for today is nothing. We're basically just signing a piece of paper, okay? So what can we do is that we have two choices here. The first choice is quite naive. We sign the loan forward contract, we do nothing, we wait for a year. A year later, I guess I can just buy the Westpac share from the other party at a price of $21. Then what I do is I immediately dump that share to the market for whatever price that is. But there's some problem with this first choice. The problem is we don't know, sitting here today, we don't know what the Westpac share price will be 1 year later, right? What if Westpac share is trading at $10? I would hate the fact that I need to buy at a $21, then I dump into the share market for $10. I make a loss. So I think maybe I should get myself prepared for this scenario, right? For our loan forward commitment. So I guess what I can do is I can short one Westpac share today. So somebody would lend me the share. Let's say John would lend me the share. And after I obtain the share, immediately I sell in the market for $22. So that's us obtaining this $22 cash flow, plus sign there. And we're going to invest the proceeds, the cash proceeds from our short selling in a bank account just to earn a bit of interest, right? So the minus 22 is us investing the $22 in a bank account just to earn a bit of interest. Okay, a year later. We are committed, remember, we're committed to buy one Westpac share at a price of $21. So that's us buying a Westpac share at $21. So that's the money going out. We spend $21 to purchase one Westpac share. But remember the short position, John lended me one Westpac share a year ago. Now he started to ring me and say, Mars, can I have my Westpac share back? No drama with that. Why? Because we got the Westpac share under our forward agreements. So we simply return that Westpac share to the person who lent us the share, right? So that's the empty cell there. It's us returning the Westpac share to the lender, to the stock lender. Okay, remember we invest the cash proceeds from the short selling position in a bank account. And that money grows with interest. So that's us getting the investment from the bank accounts. So that's $22 exponential 0.05 multiplied by 1 year horizon, that's 23 and 13 cents. You'll notice something here is that this investment proceeds, 23 and 13 cents, is more than enough to pay for the Westpac share under the forward agreement, right? So again, we're making an arbitrage profit, $2.13. In other words, this capital F, sorry, that's a typo, 21. So the capital F of $21 is incorrect. The price is way too low, right? It's underpriced. So we're getting the conclusion that neither 28 nor 21 are correct price because we are able to make an arbitrage profit here. Okay, I guess we have seen enough to understand the basic principle of this derivative valuation, right? So we're seeking to identify a portfolio that would precisely replicate the derivative. So we set up this portfolio involve the position in the underlying assets and in a bank account. So we managed to set up this three-piece strategy, right? We managed to borrow some money, we buy the asset, we sit on this asset for a year. We kind of synthetically created a loan forward position, remember? And the third piece of this strategy is us entering into a short forward. So the short forward would cancel out this synthetic loan that we've created. Going back to this column, remember, it cost us nothing to set up today. Therefore, this column here ought to be 0. Otherwise, there will be arbitrage opportunity. Can we agree on that? Right? So to prevent the arbitrage, a trading strategy costs nothing to set up today, to establish, and is riskless, then the payoff in the future must be zero. And this is our central recipe to derive the pricing formula for the forward and the futures contract. All right? So what I will do here is to substitute the number with some symbols here to derive a more general pricing formula. All right? So instead of 1 year, I will use this T as the time horizon. So instead of the actual forward price, I will use this capital F as the forward price. And I will use a little r to denote the riskless rate of interest. If we think about what is the outcome of the loan forward contract? The outcome of the loan forward contract is us owning the asset, right? I mean, we can achieve the same outcome by simply, again, I will emphasize this, by borrowing some money today, now buy the underlying assets, hold it until time t. So that kind of synthetic means like artificially create loan forward contract. And then the third piece of this strategy is just to enter into a short forward, and long forward and short forward would cancel each other out. So that should result in nothing in 1 year later. Otherwise, there will be arbitrage opportunity. Okay, so we're just going to go through this same example, same table. So this is the same table back in slide 6. By borrowing some money and buying the underlying assets, sit for a year, we create this synthetic loan forward contract. At the same time, we enter into a short forward. Now, the net consequence of that is nothing today. We can pretty much agree on that, right? Now, a year later, we deliver this asset under the short forward contract. We sell it for the agreed price, capital F. So we'll be receiving this cash flow. So that's a plus capital F there. That's us receiving the cash flow under the forward contract. Then, remember, we borrow some money to purchase this asset. So we need to repay the loan, right? We need to repay the loan with a bit of interest. So the interest rate being the riskless rate of interest, that's little r there. The capital T is the time horizon. So the minus sign really means that the money going out. Okay? So if we add on this column, it gives us this stuff here in the red circle. Going back to the definition of arbitrage, it says if something costs us nothing to set up today, the payoff in the future must be nothing as well, right? So we can pretty much equate this 0 to this red stuff in the circle here. Can we agree on that? Now, if we set this red circle to 0, then we rearrange this equation, we get our quintessential forward pricing formula. Is this formula familiar to you guys? So we somehow derive this formula by using a synthetic replication. By synthetically creating a long forward contract, at the same time entering into a short three-piece strategy. Okay? So this is going to be the baseline pricing formula for us today. And we're going to do some bit of twist. And I will show you guys what if we have a dividend yield, what if we have a storage cost, all right? But all the deviation is based on this base formula. If we can understand the intuition behind this base formula, then we have no trouble of understanding other formulas, right? Now, I would like to introduce you guys the forward pricing formula with continuous dividend yield. So the example I just gave you guys is one Westpac share, okay? It's very rare you would see that there will be a futures contract traded on one individual share. You will not find that in practice. But what you will find in practice is that there will be popular futures contract based on the market indices. So in Australia, we have ASX 200. So ASX 200 is the top 200 stocks based on the market cap listing Australian Securities Exchange, right? Effectively, what the index is a portfolio of 200 stocks listed in ASX. And we have future contract trade on that. It's called SPY 200 contract. All right? So with one Westpac share, we can check the dividend schedule. We can find out when the Westpac is going to pay us a dividend. Let's just say the Westpac is going to pay us the dividends of 60 cents on 2nd of August, right? We can find out about that. But what if we have a portfolio of 200 stocks? Remember, company will not pay dividend on the same date. That would be the situation where 200 stocks paying dividend throughout the year. We will have this constant stream of dividend coming at us, right? So it will be very troublesome for us to kind of find out the dividend, the actual dividend for every single stock. Therefore, what we can do is we can express them like yield. So we use this idea dividend yield. Okay? And we're then going to denote this dividend yield using this little q here. Because company's dividend is pretty stable throughout the year, from year to year, because manager will be very reluctant to reduce their dividends, because if they reduce the dividend, investor might think something going wrong with the company, then the stock price will go down. So manager would not do that. And the manager would not just increase the dividend, because if they increase the dividend, you kind of raising this expectation for your investor that we're going to make more money next year, right? You just make your life more difficult. You have to work harder to make more earning to pay more dividends. So manager will be very reluctant to increase the dividend as well. So I would say the past dividend yield is a good predictor for the future dividend yield. So we're just going to use the dividend yield from last year, which is no information. All right? Okay, so we're going to do the same old strategy over and over again. So we're going to borrow some money and buy the underlying 200 stocks that containing ASX 200, and that create synthetic forward contract. Remember, the third recipe is to enter into a short forward. And the long and the short are going to cancel each other out. Okay, so let's go to this. So that's just basically what I said. So borrow some money, then we'll buy every single stock containing ASX 200, that's the underlying asset. Then what we do to cancel this is to short a SPY 200 futures, right? So this synthetic long futures and short SPY 200 are going to cancel each other out. Again, we borrow some money, that's the money coming in. The minus sign really means us buying the 200 stocks. Short, just basically signing piece of contract. If we ignore the initial margin, there's no real consequence here today, right? So if we add on this column, it results 0. All right? So this positive F is us honoring our short futures contract. So we're obligated to sell. I mean, there's no drama with that. Why? Because we bought the 200 stocks a year ago. We'll be sitting on the 200 stocks waiting to be delivered. Right? So we just sell the 200 stocks and get paid this capital F here. So that's the money coming in. So we delivered the 200 stocks, so that's gone. So there's nothing in the middle. Now we have to repay the loan we took out a year ago, back in time 0, right? We have to repay the loan with a bit of interest. So the interest payment is being this little r here, right? This interest rate continuously compounded, a little r here. But there is other thing going on here. That is the dividends coming at us. Remember, the dividend from 200 stocks, constant stream of dividends. Guess what we can do with those dividends? Perhaps we can use those dividends to repay a bit of the loan interest, right? So the minus Q here is really just us using the dividends, repaying the interest payments. The minus means that this dividend really helping us to repay the loan. So we can agree on that, right? Now, remember, if it costs us nothing to set up today, the payoff in the future should be nothing. So what I can do is I can equate this 0 with this component here, right? So I simply rearrange the equation. We get this pricing formula for the asset with continuous dividend yield. What if the asset doesn't provide a dividend yield, but rather we need to spend some storage cost to store it? We can modify this equation, right? So we can imagine, what if there's a storage cost, rate of storage costs in a continuous compounded storage cost rate. Storage cost, let's imagine the underlying asset is cattle. So going back to this table here, imagine we borrow some money, we bought some cattle, right? Unlike stocks, cattle, we need to feed them, and we need to keep them somewhere. And that costs us money, right? And the additional storage cost is like additional interest rate payment we have to pay on the top of this little r here. So instead of minus q, we would have a plus u, which is additional storage cost we have to pay on the top of the interest payment we took out on the loan, right? I'll show you guys the formula in the next example, but that's quite intuitive. So why there's a minus here, why there's a plus in front of the rate of storage cost, right? So let's walk through this example. It's very straightforward. So we know that the S&P 200 market index is currently trading at 5,800, and the dividend on the index is 5% per annum, and riskless interest rate 7%. What is the no arbitrage SPY 200 future price with the delivery in 6 months' time? So we know the spot price, 5,800, and we know this riskless interest rate, which is 7%, this little r here, continuously compounded. And also we know the dividend yield is 5%, because we can use the dividends to repay some of the loan, so that's minus 0.05. And this capital T here is the time horizon, which is 6 months. Right? So we plug that into the formula, we get the correct forward price, the correct futures price should be 58.58. It has to be that price, otherwise there will be arbitrage opportunities. Right? So that's very straightforward. Okay, so let's work through another example in a situation which we need to pay, which incurs the storage cost. A futures contract over iron ore has 15 months remaining until maturity. The current future price of this contract is $200 per ton. And the storage cost of the iron ore is expressed as 4% per annum compounded semi-annually. All right? We also happen to know the current spot price of the iron ore is $190 per ton. The question says, using this information, solve for this continuously compounded risk-free rate of interest, and also told us that this market is very efficient, there's no arbitrage opportunities presented in this market. All right? So I'm just going to jump ahead to this formula which I was talking about. See, this formula is almost identical with the one that I just showed you guys with the continuous dividend yield, right? But the fact is that we have to pay the storage cost. We have to store the iron ore somewhere, and that costs us money. The additional storage cost is really like the additional interest rate we have to pay on the loan, right? So that is the little r plus the u. So the u denotes the storage cost per annum as a proportion of the spot price. All right? So both little r and little u are continuously compounded. I think there's no drama to understand this pricing formula, right? Okay. So what kind of inputs do we have? going back here, we know that the current spot price is 190, so we have the input for this S0 here, the spot price. What else do we know? We know this contract has a delivery price of $200 per ton, right? So we know this capital F has to be 200, and we were told this is the correct capital F. Because why? There's no arbitrage opportunity presented. That's what question told us. What else we were told? We were told that this contract has 15 months remaining until maturity. So we have the inputs for the capital T here, right? What else we were told? We were told that the rate of the storage cost for the iron ore is 4% per annum compounded semi-annually. Can we just plug in this 4% into this little u here? We cannot, right? Because this equation is the little u being expressed in a continuous compounded. So the first step is we need to convert this 4% semi-annual compounded storage rate into continuous compounded storage rate. Okay, so I'm just gonna, sorry, it's a bit slow with the computer here. Anyway, so this is the formula we use to convert the semi-annual compounded storage rate into a continuous compounded storage rate. I think Steve has mentioned about this formula among this lecture, right? So this little m is really the number of times that of the interest of the storage cost. So semi-annual means every 6 months. So twice a year. So that's 2 here, right? So that's 2% every 6 months. So that's a little. So that's 2 here, and this will be the 4% divided by 2, right? So 2 multiplied by natural log of 1 plus 4% divided by 2, and that provides us with the continuously compounded storage cost rate. That is 0.0396. So do we have a problem of understanding this? So we're simply converting this semi-annual compounded storage cost rate into a continuously compounded storage rate by using this formula here. All right, so after we're obtaining this continuously compounded storage rate, we can now plug into the formula, right? I'm supposed to show you the step. Oh yeah, we can show you the step. So this is the formula which we derived by using the synthetic long and a short forward, remember? We have all the information, so we have the capital F being $200 per ton. We have that information. And we also have the information on the spot price, which is $190. And we also obtained the continuous compounded storage rate by converting that 4% semi-annual compounded rate into a continuous rate, which is 0.0396. We also know that this contract has 15 months left, so that's 15 divided by 12 there. So what we can do is we can solve for this little r, which is continuous compounded riskless interest rate. So I just simply rearrange this equation by removing this $190 to the right-hand side, right? What I'll do next is I'll take a natural log on both sides. Then we can simply rearrange the equation again, and we solve the little r being 0.14% per annum, continuously compounded. Any question with that? Okay, so we still got 2 examples, so I'll quickly go through the next one. Next one is really straightforward. So give 3 reasons why a hedging strategy using futures contract may not always be perfect and straightforward. Okay, so let's just think about this, think this through. Why a hedging strategy may not be perfect? Well, the first obvious reason is that the asset whose price being hedged may not be equal to the price of the underlying assets, right? So one example I can show you is, for example, if an airline company wants to hedge its exposure to the jet fuel, there's no futures contract traded on the jet fuel, so what they have to do is perhaps they have to use the heating oil futures contract to hedge for their exposure to the price risk of the jet fuel, right? So that's the situation where the asset whose price being hedged is not equal to the price of the underlying assets of this futures contract. Okay, so that's first situation. The second reason being the hedger may not be certain of the exact date when this asset will be bought or sold. It is intuitive in the sense, if we think about the gold miners, right, gold mining company, who wants to hedge the price risk of the gold. But the problem is that the gold miners have no idea when the gold can be extracted from the ground. Right? There might be a lot of technical issue to set up the construction site, to drill a hole. There might be a lot of difficulty of drilling the hole. So whether the gold miner should choose the maturity of 12 months or 18 months, that is unknown. So the second reason is that the hedger may not be certain of the exact date the asset being bought or sold. And the third reason is the situation we encountered last week. Remember, for the bitumen futures contract example, we close out our position before it expires. The reason why we close out our position before it expires is because we don't want to bother ourselves to take the physical delivery, right? We don't want to go to Shanghai, some warehouse in Shanghai, to take that 500 tons of bitumen to somewhere remote in China. I don't want to do that. So I closed it off. So that would result in the price is different. That would result in the asset price being hedged is not equal to the price of the underlying assets. Okay? Remember, the capital F would approximate equal to the spot price right before it expires, right? If the timing is not correct, then the capital F may not equal to the S by the time the contract matures. So that is the bitumen futures contract example, which I showed you guys last week, which is the contract expires on 16th of September next year. Remember, we closed out on the 6th of September, 10 days before. So we really run into the risk that the capital F may not equal to the $4,000 of the spot price, right? Now, the fourth reason is self-explanatory. So there is no partial contracts. And there's this rounding up problem to obtain the number of contracts we needed for hedging. So last week, we need to hedge 500 tons of the bitumen exposure, right? So the underlying asset per contract is 10 tons. So 500 divided by 10, we need 50 contracts. That's a number that just worked out. What if the number of contracts we need to hedge is, let's say, 49.66? So there's this running up problem which the hedge may not be perfect. So are we cool with all four reasons why the asset price being hedged may not be the price of the underlying assets? Yeah? Okay, so if the above mentioned reason can happen in reality, I guess we're running into a basis risk. So the basis risk is having this spot price not equal to the forward price, not equal to the forward or the future price, right? Remember last week when we closed out the position, we entered 50 long bitumen futures contract at a price of 3,246. The time we closed out in late September, we need to short 50 bitumen future contract, right? We need to enter into the opposite position to close out the contract. and the price we shorted is $4,000. Right? So we made a gain when the bitumen price increased. But what if this contract which we shorted right before it expires is not equal to $4,000? Then we have this basis risk. Right? So this example illustrates that point. So a short future contract was entered into some time ago, and the initial spot price being $23.20, and the futures price at the same point in the time is $21.25. By the time this hedge is closed out, the spot price is $22.05, and the futures price being $19.08. So using this information to calculate following: first, initial basis; second, the final basis; and third, the effective price we received for this asset with hedging. So remember what I mentioned, the basis is really the difference between the spot price and the futures price, right? So we know the spot price at the initial point, which is 23.20 cents for the spot price at the initial point, and we also happen to know the futures price, which is $21.25 in the initial point. So no drama to calculate the basis at the initial point, which is simply $23.20 minus $21.25. So the basis at the initial point is $1.95. All right? We're going to repeat the same procedure to calculate the basis at the final point when the hedge is closed out. No drama with that either. Why? Because we know the spot price when this contract is closed out is $22.05. And the future price at the final point is $19.08, right? So the base is just the difference between the two, so difference being $2.97. So that's the answer to the initial basis and the final basis. Now, finally, we need to work out the effective price we received for this asset with hedging. Remember, we entered into a short futures some time ago, right? Now let's fast forward. Let's say we entered that 3 months ago. Now let's fast forward 3 months. The contract is about to expire, and we are not interested in the physical delivery. Because this is a short future contract, how can I close out my position? I take a long futures contract, right? Right before it expires. So I would take a loan. So let's go to the last slides. Remember the dual reality. We have one reality that's the profit loss we made in our futures position, and there is another reality that's the real reality happening in the spot market. So if I hide this S here, so if I just, let me just hide this. So if we just look at this part here, let's just look at this part here. We short at a price of, how much? Let me have a look. We short at a price of $21.25, right? Which means we sold at $21.25. Short means sold. Remember, we closed out by entering into the loan. So we bought at a price of $19.08. Bought means the cost we obtained this asset. So that's the total cost. That's the $19.08. Short is the price we sold for. That's $21.25. How much we made on this position? That's the difference between $21.25 and $19.08, right? So they're just F1 minus F2. So this component here represents the profit loss on our futures position. And remember, at the end of the day, we still need to sell our asset in the spot market. So how much this asset being traded on the spot market is being traded $22.05. So this plus $22.05 is us selling the asset in the spot market, realizing this $22, right? So that's money coming in. Plus the amount of gain we made in the futures position. So the effective price we realized for this asset is actually $24.22. Okay. All right, so any question with the examples we've talked through today? No? Okay, so I think we're finished. Thank you.
This strategy is only for the